Hello, my name is Pierre Rochard. I'm the lead Bitcoin strategist at Kraken. Welcome to another Kraken live stream. Today, we're going to talk with the CEO of CF Benchmarks, Chung, about CF Benchmarks, which is a regulated benchmark administrator that publishes reference rates and their Bitcoin reference rate, or BRR. Welcome, Sui, and thank you for joining us.
Thank you very much, Pierre. It's great to be here.
So let's jump right into it. First, could you give us a little background about CF Benchmarks and what the company does?
Yes, of course, Pierre. So CF Benchmarks, as you rightly pointed out, is an FCA regulated benchmark administrator. We're based here in London in the UK, and we calculate reference rates, real-time indices for single cryptos such as Bitcoin, as well as portfolios of cryptos where we've got multiple cryptos in the same portfolio, and we track their performance and publish an index of that performance.
And what problems do reference rates solve in the world of finance?
So yeah, it's a good question because it's a slightly arcane corner of finance whereby benchmarks and reference rates are used for a multitude of tasks. Primarily, though, it's for the settlement of risk. So where two counterparts have a contract, they need to settle that contract to a independently calculated, independently provided rate. So, in traditional finance, probably the best known benchmark is LIBOR, which is the measure of overnight, measure of an interest rate for overnight money between banks, between large banks with strong balance sheets. And all other forms of borrowing are referenced to that rate, such that if you're a strong company, then you would expect to pay a little bit more interest than a strong bank operating in London on an overnight basis. So that's one of the best known. And in crypto, our BRR, Bitcoin reference rate, is used to settle the CME Bitcoin futures contract listed by the CME Group, the biggest crypto derivatives contract in the world.
It is, and so within the users of the Bitcoin reference rate, so it's CME traders or futures traders at the CME. Are there others as well who are relying on this reference rate for other uses?
Yes, indeed. So obviously, best known, we've got the CME. We also have the Crypto Facilities MTF here in Europe that again settles its Bitcoin dollar futures contract to that rate. And then there are lots of OTC providers, lots of financial product providers who use the BRR as the settlement mechanism or the NAV calculation for their products, because as you know, Bitcoin isn't like a traditional financial asset. It's traded in a distributed system. So it's even more important that when there are contracts that are referencing Bitcoin, that they do so with a robust index price, because unlike, say, the price of Apple stock, you can't just go and look up the price of Bitcoin on the New York Stock Exchange, because Bitcoin is traded in so many places. So it requires a reference rate, requires requires the observation of Bitcoin dollar transactions in multiple places.
So how does CF Benchmarks calculate the Bitcoin reference rate with so many different venues and so many different, let's say, price clearing areas?
Yeah, no, sure. Yeah, it's a bit of a challenge, but what we obviously, in providing a reference rate, if you're going to use a reference rate, then the first thing that anyone who uses it wants to know is it valid? Is it representative? I.e., does it actually represent the marketplace that people are transacting in? Number two, they want to know that it has integrity, that it's not subject to manipulation, and that and that the transactions it observes are bona fide transactions. And then finally, because contracts are settling to that rate, they want to know that it's replicable, right? So if you're a market maker on the CME, market making the Bitcoin dollar futures contract, you want to know that you can actually hedge your exposure. You want to know that if you've built up a certain amount of exposure, that you can actually go and buy and sell Bitcoins at the settlement price or close to the settlement price, such that you're not running naked risk. And so our index the Bitcoin reference rate fulfills all those three through the methodology, which is number one, we observe transactions from 5 constituent exchanges today. So we look at trades from more than one exchange. So we look at 5 exchanges. Those exchanges have been vetted for a number of controls, including they have AML KYC controls, as well as, very importantly, that they have measures in place to monitor their markets and impede people from manipulative trading. That's very important because obviously, if the underlying data is affected, then so is the index affected. And to ensure the index has integrity, we need to make sure that the underlying data we're using, the trades observed on Coinbase, Bitstamp, Kraken, Itbit, and Gemini, are not themselves subject to manipulation. Very important. And what we do is we observe all the trades over an hour, over a 1 hour period, 3 o'clock to 4 o'clock London time. But what we do is we don't just use a simple VWAP. What we do is we segment that hour into 12 5-minute partitions. And we do that, when we do that, we have lots of trades in each of the 5 partitions, regardless of which exchange they come from. We calculate the volume weighted median for each of those 5-minute partitions. And then the BRR is the average of those 12 volume weighted medians. So that's what gives it the manipulation resistance. As we talked about, you need to make sure that any benchmark isn't subject to manipulation. And by using those techniques, it makes it very hard to manipulate the BRR.
That makes sense. So we covered kind of what are the different constituent exchanges that have emerged as passing, the strict standards that you've set for them?
Yeah, so as we said, there are multitudes of venues where Bitcoin is traded, but we only use 5, and they are the 5 biggest exchanges for trading Bitcoin dollar. They're the 5 biggest that meet our criteria. And those are, as I mentioned, Kraken, obviously, is one, Gemini, Itbit, Bitstamp, and Coinbase. So they together represent around 75% of all Bitcoin dollar transactions on exchanges. Because as I mentioned earlier, you have to make sure that the data you're using is representative. So you have to be looking at enough of the market for users of the index to be confident that what you're producing is representative of what's going on in the underlying market.
Now, viewers might have heard about the LIBOR scandal, but generally, what are the different forms of manipulation out there with regards to reference rates?
Yeah, so that's a good question, Pierre. As you know, cryptocurrency exchanges are not subject to capital markets regulations. So although they operate with transparency, they make their data public and they're easily accessible, they're not subject to those capital markets regulations. So a number of things can potentially happen on cryptocurrency exchanges that don't put in place the right measures to prevent manipulative trading, and that can include wash trading, which is effectively faking volume, so creating fictitious transactions where it's not a bona fide transaction, just to make the volume seem greater than they actually are. Then you have spoofing, which is a technique whereby one puts in effectively fake orders, particularly with algorithmic trading, where you have users who will post orders and then immediately pull them at prices that are varying to the prevailing price, so that it makes other traders think that there is more interest to buy or sell at an artificial price. Effectively, that's possible. And we've seen there's well-documented cases of that happening on cryptocurrency exchanges that are not the constituent exchanges that CF Benchmarks uses. To ramping, whereby you have participants buying very small amounts of relatively small amounts of crypto at hugely inflated prices, and doing so in cahoots in concert with their co-conspirators to make it seem as though there is a market for an asset at a price higher than there actually is. So there are many pitfalls out there that CF Benchmarks avoids, and the users of our reference rates can be confident that we have, that those sorts of behaviors do not make it into the data that we use to calculate our reference rates.
Got it. And so you mentioned that there's already some mechanisms for making the reference rate resist against manipulation like this, with the windows. How was that specific time chosen? The 3 to 4 p.m. London time.
Yeah. So as I mentioned, at the top, being representative of the market is very important for a reference rate. So if you're going to observe trades over a certain whatever time period you choose, you want to be observing the market at its most active, at its most liquid. And in the Bitcoin dollar markets, what we see, and this is where Bitcoin and crypto is quite similar to traditional finance, in that the most active time, the most liquid time on average is between 3 and 5 o'clock London time, which makes sense because that's when both Europe and the US and the majority of the US are open, where people are awake and at their desks. And even though crypto is obviously a global phenomenon, it's traded all around the world, it's still the case today that the majority of trading is taking place with European and US-based participants, at least the volume is, and hence, that the most liquid time is between 3 and 5, as we've observed, and so we took the earlier part of that, the 3 to 4, because that's when we observe the trades. Obviously, we then need to do our calculations, we need to publish, etc., and we want to be able to do that whilst the majority of the participants in the market, who we've said are Europe and the US, are awake trading at their desks. And so we publish at around just after 4 o'clock London time.
And Bitcoin is obviously always in the news because of its volatility. How does the reference rate, does Bitcoin's extraordinary volatility affect the methodology for the reference rate? Or is it just not something new to the world of finance, where there are other assets that reflect the same level of volatility?
Yeah, that's a great question, Pierre, because people talk about the volatility of Bitcoin, and yes, Bitcoin is volatile, but there are other financial markets, and particularly the commodities areas, commodities finance, where you have assets that are just as volatile as Bitcoin, in some cases more volatile than Bitcoin. If you look at the US power markets, for instance, the US power markets are incredibly volatile, and more volatile than Bitcoin. So it's not something unique to Bitcoin, number one. Number two, I think sometimes the volatility of Bitcoin is amplified by the fact it's a 24/7 market. Traditional finance, 10 hours a day, 5 days a week. And so what happens is that, trading is concentrated at those times, which means that there are no lulls in liquidity, or relative, it's not as extreme when you have a lull in liquidity, number one. Number two, the 24-hour news cycle does not have the same impact in traditional financial markets. So, in traditional finance, if traditional finance operated 24/7, I'm pretty sure volatility would go up. Observed volatility would go up. But as regards reference rates, yes, we need to be cognizant of the volatility that is observed, and as part and parcel of our methodology, we have safeguards. Most benchmarks will have safeguards. Most reference rates will have safeguards in removing outlier data, in the way that it screens its data for quality assurance, just like we do. But when you have a more volatile asset, the parameters by which you apply those quality assurance measures, that's where you take into account. You have to have a bit more leeway. So to give you an example, we also, as well as Bitcoin and Ether and the more established cryptocurrencies, we also publish a reference rate for the Pax Gold stablecoin, which, as you know, some of your viewers might know, is a stablecoin pegged to the price of gold. It's a tokenized form of gold. Even though we're observing the trading of Pax G tokens on the same exchanges as observing Bitcoin, the parameters for quality assurance there are narrower because it is tokenized gold. Gold is less volatile than Bitcoin, at least historically, and hence the parameters are a bit tighter. So yes, the volatility doesn't affect the sort of main methodology, but it affects the safeguards and the way you operate those safeguards for the reference rate.
Got it. And what is the benchmark surveillance component? And so, and how does the benchmark get updated in its parameters?
Sure. Yeah, that's a good question. So, as part of our FCA regulation, we have an obligation to surveil our benchmark, to look out for potential manipulation, because obviously there are financial products out there referencing the benchmark, and it's our job to make sure that people aren't manipulating markets via manipulating our benchmark. So we have our safeguards in place, but we also have surveillance. We also monitor all the input data that comes in. We run various forms of analysis, correlation analysis, statistical variance analysis, and all the data that comes in to make sure that there isn't that someone isn't trying to manipulate the benchmark, trying to move the benchmark away, move our reference rate away from its true measure of bona fide transactions in the underlying markets. So we surveil, and then obviously if we see any behavior that looks like it could be trying to manipulate the benchmark and hence potentially affect the markets, affect the products that reference our benchmark, and we have a series of escalation measures in place that ultimately, if we do find someone has done that, then obviously that we need to take a very long, hard look at our processes, our methodology, adjust them accordingly, make changes. But thankfully, we haven't had to do that in the four plus years we have been calculating the Bitcoin reference rate. I think largely because our vetting process is so rigorous that we still today only use 5 exchanges to calculate the rate, and And yeah, we've done some analysis that you'll have seen where, the Bitcoin dollar markets, as observed through the 5 constituent exchanges, display remarkable integrity. When we use traditional techniques to analyze price behavior amongst the 5 exchanges, like pairwise correlation of transactions conducted on each of the 5 exchanges. So that's where we say, okay, if we look at the transactions in series conducted on different exchanges, the price direction that they take, each trade, one after the other, the price direction that they take, do they all move in line? Because you would expect to see that in a market of high integrity. You would expect to see that, if the price is going up on Coinbase, it will also go up on Kraken. If the price is going down on Bitstamp, it will also go down on Gemini. And if you use that sort of analysis, then we've demonstrated that the Bitcoin dollar market is certainly comparable to, the way we think about it is, there are some stocks out there that are listed on multiple exchanges. So for instance, you see this a lot with banks. So big banks out there like HSBC and Barclays are listed in London, they're listed in New York, they're listed in Hong Kong, because people all over the world will want to be trading the stock. So they're listed on multiple exchanges. And so that is analogous to Bitcoin being traded on multiple venues. And so if you analyze HSBC, the price of HSBC stock on different venues, you will see there will be discrepancies from time to time. The price will be going up in New York, whereas it will be going down in Hong Kong, or vice versa, but very, very rarely. And what we see with Bitcoin is Bitcoin dollar markets is very similar. That we're talking 98% of the time the prices move in concert, and it's only very rarely that their correlation comes to anything where the correlation breaks down or the correlation gets weak. The correlation is very high for almost all of the time.
I see. And is that reflective that there's a common set of traders among these exchanges that are doing arbitrage between them? Like, what are the underlying mechanics that make it such?
Yeah, so it's a good point you bring up there, because obviously arbitrages are one of the components that drive price uniformity across different venues. So absolutely, the presence of arbitrage does that, number one. I think number two, I think that the crypto trading community, it's a broad church. There are, all the way from people who are very new to trading crypto and are doing it point and click on a screen, all the way through to arbitragers. But there's a lot of people in between as well who are trading on multiple venues, using smart order routing systems whereby what they want to do is buy Bitcoin at X price, and they're pretty agnostic to which exchange it gets executed at. So they will have algorithms that just say, we want to buy at this price, we want to sell at this price, regardless of which exchange. And so obviously they're feeding in orders onto multiple exchanges, transacting on multiple exchanges, but again, looking for specific price, and then people are filling that. So you create an ecosystem whereby naturally prices move in concert within very narrow bands, and the observed pricing for investors is very tight.
How do flash crash liquidation events like March 12th, where the word on the street is that exchanges that are not constituent exchanges of this index are setting the price due to leverage being liquidated? Does that impact these spot exchanges and this reference rate?
Yeah, so it's the price transmission, the lead lag, as it's known in the industry, is an interesting question. Yes, certainly derivatives markets have an impact, no doubt about it, whereby if you have liquidations of derivative markets because of their leverage, then to fill those liquidations and to make those liquidations whole, then market participants will go to the spot market to hedge out the risk that they've taken on. That, of course, happens. But I think that the relationship may not be as one way and as linear as some people would make out, I'd say, number one, because a lot of those markets are completely synthetic. The market makers are completely synthetic. They will have other means other than transacting on the spot markets to hedge their positions, and then also a lot of positions are unhedged, quite frankly. So yes, there is a transmission, and I think futures markets have, in our analysis, futures markets have been seen to lead the spot market, but at the same time, you can't transact on one in isolation, right? Fundamentally, if you're going to be trading Bitcoin as an institutional size participant, you can't really do so. You can't really do so in isolation. So yeah, we see that traders, people who are trading significantly in the spot market will be trading significantly on the CME, for instance, will be trading on other venues. So yeah, it's probably not quite as clear-cut one-way traffic as some would make out.
Thank you for joining us on today's Kraken live stream. We learned a lot, and we look forward to doing another live stream in the future.